Hello, this video discusses a few details involved in doing homework problem 1 in APEC 4501. If you retrieve the Excel template from the Moodle site, first you see some rates and assumptions in the top section here, sales growth rate and cost percentages and so on, that you'll use to fill out the income statement for years 1 through 5 based on the starting information for year 0 that's in column B. So the sales in year 1, then, if we click on C15, would be equal to the previous year's sales times these 1 plus the sales growth rate of 10%. And since we only have the growth rate in one cell, we need to use the F4 key to freeze with the dollar signs the sales growth rate. So the year 1 amount is 1100, and we can copy that on out to the other years. The assumptions are the cost of goods sold is 50% of the sales value. So cost of goods sold is in the next row, so we can calculate that as the equal the sales times the 50%, but since sales are positive and cost would be negative, we need a negative sign, and so you get cost of goods sold. And again, I forgot to put the dollar signs on the percentage, so we need to do that. And I won't show you all the rest of these because they're pretty straightforward. But there are a couple items in the income statement and balance sheet that are simultaneously determined, and that adds a little bit of complexity to the calculations. For example, the interest earned on cash and marketable securities is based on the cash and marketable security amounts in the balance sheet, which in turn are determined by the income statement. So we enter them and we wind up with an error message from Excel unless you have the settings set to handle iterative calculations. So if we put in the interest on cash and marketable securities, and that's the rate from the assumptions times the average of the previous period securities plus the current period securities divided by 2. That gives you a circular reference warning, and it tells you where that is. And so if you get that, go to Excel's options and see the formulas item in the left margin, and look for the box at the upper right called Enable Iterative Calculation. Click that. The depreciation calculations in row 19 have the same simultaneity problem because they're based on the average of the fixed assets at cost in line 30 from the previous year and the current year, the average of the previous year and the current year. So once you get the income statement and balance sheet completed, then scroll down, and step 2 asks you to do a table calculating the free cash flows for all 5 years, and so that'll be the next step. So bring down the profit after tax that we had before in our income statement, and then add back in the depreciation, and you need to add back in the interest on debt and on cash and marketable securities, but they need to be on an after-tax basis. So you need to multiply the amounts from the income statement times 1 minus the tax rate for those calculations. So the after-tax interest on debt would be the minus the interest on debt we calculated before times 1 minus the tax rate, after-tax interest on cash and securities would be that times 1 minus the tax rate. A couple other things: the increase in current assets isn't an expense for tax purposes, but it is a cash drain on the company, so we need to subtract that, and also add back the increase in current liabilities, and finally subtract the interest in fixed assets at cost. So just make sure we get the signs right on everything. The profit after tax is a positive number. Add back in depreciation is positive. When you subtract the interest in current assets, that's negative. But the adding back the interest in current liabilities should be a positive number. So make that change, and everything else looks okay there. So the free cash flow then should be 176 for year 1. Copy that out. So that's what you should get for step 2. Then in step 3, you need to prepare a table that calculates the value of the firm and its equity, and compare that against page 114. So first thing we do on that would be to bring down the free cash flows we calculated in step 2. And then the more complicated part there is to calculate the terminal value of the firm, and that's a proxy for the present value of free cash flows following the year 5. And so the way we calculate that in G59 then would be the year 5 free cash flow times 1 plus the long-term growth rate that we expect for free cash flow, which we're assuming is 5%, and then divide by the difference between the weighted average cost of capital and the growth rate, or 20% minus 5%, and that gives us a terminal value of 1598 there. And so the total value of the firm then would be the sum of the current year free cash flows and the terminal year, and we get 1826 for the year 5 total value of the firm. The enterprise value of the firm is the present value of the annual values of the firm, and so we can use the NPV function there, where the rate is the cost of capital, and the period values would be the total values of the firm, and so that gives you 1231. You need to add to that the initial value of the cash and marketable securities that we started with in our initial balance sheet of 80, and so that gives us our initial asset value in year 0, 1311. Subtract out the current value of the debt of the firm, which is our 320 from our balance sheet, and so the equity value of the firm then would be the difference there, or 991. In step 4, you need to prepare a one-way data table that looks at how the value of the firm's equity would change with different assumptions about the growth rate of sales, which was way up in cell B2. So we can add a label for our data table: growth rate, equity value, and so starting with a baseline growth rate of 10%, and so let's go from 0 down to about 16% by increments of 0.02 or 2%. And so we can format that, or bring down the equity value as our result cell for our data table, and then highlight the changing cells and the result cell, data, what if, data table. And this is a vertical table, so we need to change the column input cell and point that at the sales growth rate. Format our results. You'll see that the equity value declines as the growth rate goes up, but Benninga uses mid-year discounting for the enterprise value of the firm in that calculation, and rather than the end-of-year numbers that we use, we can try putting in that extra calculation, which is basically discounting our present value by a 1/2 of a year, or multiplying our NPV function by 1 plus the discount rate to the 1/2 power. Step 5 then asks for a two-way data table that looks at the value of the firm's equity for different combinations of the free cash flow growth rate and the weighted average cost of capital. So we'll come down to an open area on the spreadsheet, and we'll put the weighted average cost of capital across the row, and we'll put the free cash flow growth rate in the column. Let's vary the cost of capital from 10% to 26%. We'll start out with 0.1, vary it by 2% increments, so we get that, and growth rate in free cash flows will go from 0 to 16%. Results cell again would be the equity value again, and so let's put in our data table. This time the row input cell is our weighted average cost of capital, and the column input cell is our free cash flow growth rate. Now notice that the results get kind of wild if the free cash flow growth rate is less than or greater than or equal to the weighted average cost of capital. And so we really don't want to calculate it in that case, and so we can go up to the results cell and put an if statement in if the free cash flow growth rate in B55 is greater than or equal to the weighted average cost of capital. Then we'll just put in NMF for not meaningful, and otherwise show the result. Step 6 asks you to go up and modify the balance sheet along the lines of exercise 6 in Benninga's chapter 3, and modify your debt calculation here to make sure that you have at least 25 for the cash and marketable securities. And it's not a problem in our baseline analysis here. Cash and securities start out at 80 and go up to 459 at a 10% sales growth rate. But if we did grow a lot faster, say 25%, then we run into a problem with cash. And so we can deal with that. We think about debt as the residual here. In the formulas we've got here, we just hold debt constant at the previous year's value. But we could use a max function and say want this to be the maximum of current debt, or the difference between current and fixed assets and stock and accumulated earnings. If we add current assets and net fixed assets, and then subtract current liabilities and stock and retained earnings, then it doesn't change for year 1, but if we copy that on out, then it adds to debt to make sure that we have enough cash. The other thing we need to add here is the minimum cash that we want to have on hand, which you could plug into an empty cell up here. The way Benigna does it, he plugs the 25 into the formula, but that's kind of bad practice. It's good to break out your assumptions into a place where you can see them. And so if I add in the minimum cash with dollar signs again and then copy it across, you see that the cash comes down to our 25 minimum and then holds there, and debt goes up to offset the cash need. Step 7 then asks you to add some formatting and background information, and I'll let you do that on your own.